Hey everyone, welcome back to the Noob Selling Options channel. I'm absolutely thrilled to have you hanging out with us today. We've got a brand new explainer for you, and honestly, the timing on this one is absolutely critical. We're looking at the highly charged, almost feverish state of the market right now, and more importantly, we are building a tactical playbook for exactly what to do next. If you've been watching the charts lately, you know things have been moving incredibly fast, and having a structured, emotionless plan is your key to not just surviving, but really thriving.
Right off the bat, let's just address the giant elephant in the room, that massive mega-cap tech-driven April rally. I mean, it was truly one for the books, right? It pushed the broader indices straight up into blue sky territory. And look, it's a super exciting time to be an investor. But, as you probably know, when markets get this euphoric, the smart money immediately starts planning their next moves. And that is exactly what we're going to do today. We're decoding this whole rally to figure out where the absolute safest, most profitable entries are hiding.
Here's how we are breaking it all down. First, the overstretched market landscape. Second, mapping the inevitable retracement. Third, identifying our prime targets, Meta and Microsoft. Fourth, striking when fear returns. And finally, building a portfolio fortress strategy.
Okay, Section 1, the overstretched market landscape. Checking the gauges. So, to kick off May, the S&P 500 skyrocketed all the way up to roughly 7,230. The sheer velocity of this buying pressure has just been astounding to watch. We blew completely past the 7,168 to 7,200 zone, which, by the way, was a very heavy institutional target area. Usually, institutional players use these specific zones to lock in profits, but instead of stalling out, the market just triggered this massive wave of short covering and retail FOMO buying that left all previous resistance totally in the dust. Now, sure, the technical picture is unanimously bullish right now, but a move this fast, it forces us to look under the hood. When the market moves with this much pure velocity, completely unbacked by any immediate structural support underneath, it becomes highly vulnerable to sudden air pockets. The buyers simply exhaust themselves.
To see what I mean, just look at the 14-day Relative Strength Index. Our RSI is currently sitting at 71.2. In technical terms, anything over 70 officially puts the market into overbought territory. Think of the market kind of like a giant rubber band. Momentum is fantastic for riding the wave up, but right now, that elastic is pulled completely tight. Historically, when the S&P pushes past 70 on the daily RSI, we enter a critical window. Momentum can absolutely stay irrational for a bit, but the probability of a sharp mean reversion spikes dramatically. Now, that doesn't mean a massive world-ending crash is coming tomorrow, but within days or maybe a couple of weeks, we usually see that tension release. The market just needs to breathe, and this is exactly why we never buy the top, we prepare for the snap.
To really put this into perspective, just look at the staggering gap between our current index level and our foundational moving averages. The 50-day moving average, which is our dynamic support, is hanging way down there at 6,821. And even more importantly, the 200-day moving average, our long-term structural bedrock, is all the way down at 6,728. Being more than 5% above the 200-day moving average is a literal statistical outlier for the S&P 500. Historically speaking, this kind of extreme detachment absolutely requires a cooling-off period for the averages to catch up. That usually happens either through a long, choppy period of sideways consolidation or, and this is way more common, a rapid pullback. The structural bedrock is simply too far down to act as a safety net right now, which absolutely confirms the need for a retracement.
Moving on to Section 2, Mapping. The inevitable retracement, finding the floor. So if we draw a standard Fibonacci retracement from the March lows all the way up to those May peaks, we get a fantastic roadmap of exactly where buyers are likely to step back in. A 23.6% retracement lands us right around 7,053. This is what we'd call a shallow pullback, but it's crucial because it aligns perfectly with the psychological 7,000 support mark. And you know how it is? That 7,000 mark is a massive psychological barrier for both retail and institutional traders. Option chains are always heavily loaded around these big round numbers, so it's an excellent first area to start scouting for premium if you're writing cash-secured puts. Taking a step further down, the 38.2% retracement sits at 6,918. That represents your standard, totally healthy technical correction. This is the spot where aggressive dip buyers, the ones who completely missed the April rally, will likely start stepping in. That makes it incredibly fertile ground for harvesting option premium.
But here's where it gets really interesting. Notice the incredible confluence at these deeper levels. Step 3. The 50% retracement at 6,808 aligns almost flawlessly with our 50-day moving average of 6,821. If momentum really breaks down, this is the true fortress level. This is exactly where algorithmic defense walls are built by the bulls. And hey, if things get truly choppy, the 61.8% golden ratio flush sits right at 6,698. Look at that, it aligns directly with our 200-day moving average. Structural buyers, pension funds, long-term algorithms, they defend the 200-day fiercely. These are not just random arbitrary lines on a chart. These are massive structural convergence zones where the risk to reward for bullish setups becomes wildly asymmetrical and totally in our favor.
All right, Section 3, Prime Targets, Meta and Microsoft.
Let's talk specifics. Meta is actually giving us a nice little localized retracement right now, trading around $608, down from $688. And listen, this isn't because of bad earnings. They absolutely crushed their earnings. It's simply because the market is busy digesting their massive infrastructure CapEx guidance. This earnings gap down totally juiced Meta's implied volatility, creating a textbook picture-perfect environment for selling puts. On the flip side, we have Microsoft trading around $414. Its implied volatility is definitely tamer, showing tremendous relative strength. If the broader market pullback drags Microsoft down into that $390 to $400 support zone, it sets up a prime put writing area with a tremendously wide margin of safety.
Now, you might be wondering, why these two specific names? Well, because when you are looking to catch a falling market, you absolutely must ensure you are landing on solid ground. Both Meta and Microsoft are structural industry leaders. They have massive, undeniable tailwinds in AI and infrastructure right now, and most importantly, they have the ironclad balance sheets required to easily weather any broader market correction. When the market inevitably pivots and starts its next leg up, these are the heavyweights perfectly positioned to lead the charge.
Section 4, Striking when Fear Returns.
After that euphoric April surge, sentiment has naturally been skewed completely toward greed or extreme greed. Euphoria crushes the VIX, and option premiums just dry up completely. So what are we actually waiting for? Fear. In market terms, fear is simply a rapidly spiking VIX that inflates implied volatility across the board. We absolutely must wait for the pendulum to swing back into the fear or extreme fear zones before we strike with our entries, whether that's for puts or direct stock purchases.
Structurally speaking, a spiking VIX equals massive implied volatility expansion. When IV expands, the premiums on those cash-secured puts for Meta and Microsoft become significantly richer. Basically, you are getting paid substantially more money to take on the exact same risk at the exact same strike prices. By actively waiting for fear to return, you're usually catching the market right at those 38.2% or 50% Fibonacci levels we mapped out earlier. And combining that lower stock price with inflated option premium, that pushes your break-even point incredibly low. Guys, this is exactly how you manufacture a massive downside cushion for your portfolio.
Section 5, Portfolio Fortress Strategy. Patience pays the highest dividends. I know, it is incredibly tempting to chase a crazy run-up and succumb to the FOMO. We've all been there. But building a fortress-like portfolio requires strict, unemotional discipline. It means letting the market flush out all this current exuberance and just waiting for that stretched rubber band to finally snap back. It means waiting to deploy your capital entirely on your own terms, maximizing your income while actively minimizing your downside risk.
Before we wrap up, I want to leave you with a provocative question to chew on as you update your watch lists this week. What specific sectors or individual tickers are you watching most closely right now to gauge if this market breadth can actually sustain itself? Is there a canary in the coal mine that you are keeping a close eye on? Let me know down in the comments. I love reading your thoughts, and I read every single one of them. Thank you so much for joining me on the Noob Selling Options channel for today's explainer. If you found this breakdown helpful and you're ready for the retracement, please hit that like button and subscribe to the channel so you never miss out on our tactical market updates. Stay disciplined out there, and I will see you in the next one.